Hello, all my dearest students of CA Final Full English. I hope you all are doing good. I hope your studies are going on great for your upcoming exams. So today we are going to start with our revision of transfer pricing, one of the most important topic which is 100% going to come in your examination, which is also important for your practical life as well. So let us start with the comprehensive revision in full English of the topic of transfer pricing. Now, all the provisions of transfer pricing are given under section 92 to 92F. So it's a small topic actually if you see the number of sections, but yes, content wise it is a very big topic. There are very few sections in this topic, but every section has huge content. So 92 to 92F has all the provisions of transfer pricing. Now the very first section of transfer pricing, that is section 92, talks about the charging section of transfer pricing, which means when transfer pricing is applicable under the income tax law. In that they have put three subsections: subsection 1, subsection 2, subsection 3. Subsection 1 says that if you earn any income, if any income is arise to you, then you should compute, and income is arise from international transaction, then you should compute your price as per arm's length price. So if there is any income which has arise from international transaction, then you should compute the arm's length price. What do you mean by the term income? Income may include sale also, income may include purchase also, income may include expense also, income may include interest also. All these things are income. Income can be impacted because of all these things. Income can be impacted because of sale. Income can be impacted because of purchase. Income can be impacted because of expenses. Income can be impacted because of interest expense also. So any income which is arising from international transaction. What do you mean by international transaction? The definition of international transaction is given under 92B. There we will see what is the meaning of international transaction. So any income arising from international transaction shall be computed as per arm's length price. What do you mean by arm's length price? In simple words, arm's length price means genuine price, but technical definition of arm's length price is given under 92C. We will see that in 92C in a while. Now, this section is not only applicable for international transaction, but it is also applicable to certain specified domestic transactions mentioned under 92BA, which we will see later on. Majority of the provision, majority of the chapter is important from the perspective of international transaction. But yes, transfer pricing is not only applicable to international transaction, transfer pricing is also applicable to certain domestic transactions, not all, to certain domestic transactions, which we will see after some time. Now, transfer pricing is also applicable if there is a cost allocation and apportionment between associate enterprise. There is one company and there are multiple subsidiaries across the nation, and they are developing some product and they have incurred some cost. Now they want to allocate the cost or apportion the cost between all the entities. The cost allocation and apportionment should also be done as per arm's length price. This is what 92 subsection 2 says that. Now 92 subsection 3 is a very important subsection. What does this say? This says that transfer pricing is not applicable if after applying the transfer pricing, the income of the assessee reduces or the loss of the assessee increases. So after applying the arm's length price, if the income reduces or the loss increases, it means after applying the arm's length price, it is beneficial to the assessee, then transfer pricing is not applicable. So after applying the transfer pricing provision, it should not benefit the assessee. It should benefit the department. If it benefits the assessee, transfer pricing is not applicable. How it benefits the assessee? By reducing the income, by increasing the loss, transfer pricing not applicable. I hope it is clear to all of you. Now, one of the most important conditions for applying transfer pricing is the relationship between two entities. When an entity enters into a transaction with another entity, both the entities should be associated enterprises. If both of them are associated enterprise, then only transfer pricing is applicable. Otherwise, transfer pricing provisions are not applicable. Now, the question is, what do I mean by associated enterprise? It is defined in section 92A. And there are around 11 to 12 cases. If you fall in either of the cases, you can say that the two enterprises are supposed to be an associate enterprise. Let's see all the 12 cases one by one. All the 12 cases shall happen at any time during the previous year. If at any time during the previous year any of the activity is happening, you are associate enterprise. It is not necessary that the 12 conditions should concurrently be following throughout the 365 days. Not necessary. If all these 12 conditions, either of the 12 conditions has happened even for a moment during the previous year, then you both are associate enterprise. First, when one enterprise holds 26% or more voting power in another enterprise. So if I hold 26% or more voting power means equity shares. If I hold 26% or more equity shares in another entity, we both are associate enterprise. Second, I am Mr. A, there is Mr. B, there is Mr. C. If I hold 26% equity in Mr. B and if I hold 26% equity in Mr. C, then B and C will also be considered to be associate enterprise. So if A holds 26% in B and if A holds 26% in C, therefore B and C will also be called as associate enterprise. Point number 2, it is mentioned. Now in point number 1 and 2, the relationship of 26% can be direct or indirect. Direct means A holds 26% in B, A and B are associate enterprise. Now A holds 80% in B and B holds 40% in C. A holds 80% in B and B holds 40% in C. So indirectly A is holding in C 32%. 40% of 80%. Therefore, indirectly A is holding in C how much? 32%. Therefore, A and C are also what? Associate enterprise. Indirect holdings are also covered. Direct holdings are also covered. Point number 3, let's come to one of the most important point, one of the most commonly asked point. If I finance 51% of the book value of your assets, if I finance 51% of the book value of your asset, then we both are associate enterprise. So what I am supposed to take? I am supposed to take your book value of assets and then I am supposed to take how much I have given as a loan. If that comes to 51% or more, we both are associate enterprise. Now, fair market value of asset is not important. What is important is book value of asset. Condition number 4. If I guarantee at least 10% of the total borrowings of your company or your enterprise, then we both are associate enterprise. Condition number 4. Whatever is the total borrowing, if I give at least 10% of that, we both are associate enterprise. Condition number 5 itself has 3 points. Condition number 5 itself has 3 points. Suppose I am one company, you are another company. If I appoint more than half of the directors of your company, or if I appoint more than half of the members of the governing board of your company, we both are associate enterprise. If I appoint more than half of the directors of your company, or if I appoint more than half of the members of the governing board of your company, we both are associate enterprise. Second criteria, if I appoint just one executive director of your company, we both are associate enterprise. Third criteria, if I appoint just one executive member of the governing board, we both are associate enterprise. Just one executive member of the governing board. For normal director and for normal member, it should be more than half. For executive director and executive member, just one is sufficient. Next, point number 6. Point number 6 is cross-holding. I am Mr. A, there is Mr. B, there is Mr. C. I am A Limited, there is B Limited, there is C Limited. If I appoint more than half of the directors of B Limited, and if I appoint more than half of the directors of the C Limited, B and C are associated. If I appoint more than half of the members of the governing board of B Limited, and if I appoint same year also, both of them are associate enterprise. If I appoint one executive director here, one executive director here, both of them are associated. If I appoint one executive member here, both of them are associate enterprise. Any combination of these 4 items, if I appoint in B, if I appoint in C, B and C will become associate enterprise. Check it, please. Point number 7. Point number 7 talks about the situation where you are dependent on the intangibles of the other person. So if I am wholly dependent on the intangibles of another entity, I am wholly dependent on the know-how, patent, copyright, trademark, license, franchise of another enterprise, then me and that entity will be considered to be deemed to be associate enterprise. But the dependency has to be wholly. If it is partly, then associate enterprise is not possible. To make associate enterprise possible, the dependency has to be wholly. Next, raw material dependency. If out of total raw material, 90% of the raw material I purchase from you, 90% of the raw material I purchase from you out of total raw material, then I and you will become associate enterprise. If I am dependent on 90% of raw material from one entity, then that entity and me will be associate enterprise. Next one is slightly dangerous point. Goods are manufactured by me and I sell to you. I am making some goods and then I am selling to you. But the price and other factors are influenced by you. You will decide the price, you will decide the credit period, you will decide how the delivery will be made, you will decide how the warranty will be given, everything will be decided by you. So the transaction is influenced by you. So how will we come to know? That will be mentioned in the agreement, that it is influenced by the buyer. Therefore, I and you will become associate enterprise. Check it, please. Point number 10. When one enterprise is controlled by individual, I am an individual, I control one enterprise, and another enterprise is controlled by me or my relative or jointly by both of us. So one enterprise is controlled by me in India, and in outside India, another enterprise is also controlled by me or my wife or my wife individually, then me and that enterprise will become associate enterprise. I hope it is clear to all of you. Next, HUF is carrying on business in India, and the member of the HUF and the relatives are carrying on business outside India. So HUF is carrying on business in India, and outside India there is one enterprise in which the member of the HUF or the relatives of the members of the HUF have formed one enterprise. So my HUF and that enterprise will be deemed to be associate enterprise. And last but not least, I am a partnership firm. I am an AOP BOI. If any person has 10% stake in my partnership firm or my AOP BOI, then that person and my firm will become associate enterprise. Just 10%. Who holds 10% or more in my entity, then that partner and my firm will become associate enterprise. And last but not least, if CBDT wants, they may prescribe few more cases. As of now, they have not prescribed anything. If they want, they might prescribe few more cases. As of now, there is no more prescribed, no more prescribed items. Only 12 items are prescribed as of now. If you fall in any of the 12 items, you are said to be what? Associate enterprise. To apply transfer pricing, having associate entity relationship is extremely important. Without that, transfer pricing is not possible. Now let's talk about international transaction. Because what is written in subsection 1? Any income arising from international transaction shall be computed based on arm's length price. So what is international transaction? There are 2 points in international transaction. Subsection 1 talks about the definition of international transaction, and subsection 2 talks about the definition of deemed international transaction. First of all, let's talk about basic international transaction meaning is what? Sir, what do you mean by the term international transaction? International transaction, first of all, can be called as international transaction if it is entered between 2 or more associate enterprise. The transaction has to be entered between associate enterprise and one of the parties should be non-resident. One of them should be non-resident. Sir, can both be non-resident? Yes, both can also be non-resident. Then you have to prove that the transaction is taxable and accrued in India. Sir, can both be non-resident? Both non-resident is possible. Sir, one of them can be non-resident. Yes, one of them can also be non-resident. Sir, can both be resident? Both resident, not possible. If you want to make a transaction international, one of them should be non-resident. Both resident, not possible. And then the transaction should be in the nature of what? Purchase, sale. You can write as many points as you want, not very important to remember. Lease, transfer, use of intangible, tangible property, provision of service, nature of capital financing, borrowing, lending, guarantee, business restructuring like amalgamation, demerger, slump sale, etc. You can do any of them. All these are different natures of transaction. Now let's talk about what is deemed international transaction. Deemed international transaction has been put under section 92B subsection 2 with some intention, where the assessee is trying to evade tax. Now pay attention please. X is in India and Y is in Australia, and X and Y are associate enterprise. Now, if they enter into a transaction whether transfer pricing will apply, the answer is yes, because both of them are associate enterprise and one of the parties non-resident, Y is non-resident. So, what they are doing? They are not doing transaction with X. They are doing transaction with Z, which is an unrelated party, and they are entering into a prior agreement. They are saying that X will sell some goods to Z, and Z and Y will enter into a prior agreement that whatever goods will be sold by X to Z, Z will sell it to Y ultimately, and the goods will ultimately go to Y in Australia. So therefore, you are trying to indirectly evade tax, indirectly evade transfer pricing provisions in India. So therefore, the law made a provision. What provision? If any entity enters into a transaction with third party and the third party already has a prior agreement with your associate enterprise. If you enter into a transaction with third party like Z and that Z already has a prior agreement with your associate enterprise, then the transaction between you and that third party will be deemed to be international transaction. And in that, one more catch is that the residential status of Z is not relevant. If Z is non-resident, then also it is deemed international transaction. If Z is resident, then also it is a deemed international transaction. This is the only exception under the entire income tax law where X is also resident and Z is also resident. Still transfer pricing is applicable. Both are resident. Generally, I told you now, one of them should be non-resident. But in this exceptional cases, even if both are resident, still transfer pricing provisions are applicable. I hope it is it is understood to all of you. Now we will talk about computation of arm's length price. Because again in 92 subsection 1, what is written? Any income arising from international transaction shall be computed having regard to the arm's length price. So if transfer pricing is applicable, you have to compute the arm's length price. Sir, what is arm's length price? Arm's length price in general terminology means a genuine price. But what do you mean by the term arm's length price in the context of income tax law? So you have to understand 92C and its rules now. Now in 92C, there are 4 subsections. The very first subsection says that the arm's length price of the international transaction or the domestic transaction has to be computed by the assessee himself having regard to the most appropriate method. The law has given 6 methods. You have to select best method out of you which is the most appropriate for you. Sir, how will I select the most appropriate method? Depending upon your nature of transaction, class of transaction, nature of associate enterprise, and many other factors, functions performed, asset employed, many factors you have to analyze and find out which is the best method out of all 6 methods. But you have to select the most appropriate. We are not giving you option to select any one which you like. You have to select the most appropriate which is applicable in your case. The 6 methods are not given as a choice that select any one out of them. No. You have to select the most appropriate out of them. So which are the 6 methods? Comparable uncontrolled price method is the first method. Then resale price method, cost plus method, then profit split method, transactional net margin method, and last one is any other method which CBDT may prescribe. The last one is not very important. The CBDT will prescribe on case to case basis. If you are not able to classify your case in the first 5 methods. Once you select the method, then you have to apply the relevant rules and find out the arm's length price. You have to find out the arm's length price. Department is not going to find out the arm's length price first. First, assessee will find out the arm's length price. Okay, understood, sir. After that, you file the income tax return, and then the AO has the power during the pendency of the assessment. The AO has the power to determine the arm's length price if you do any of the 4 things. If he finds you doing any of the 4 things, he has the power to determine the arm's length price by issuing you a show cause notice. Sir, what 4 things that I should not do that so that AO should not interfere in between? First, he should not be of the opinion that the price charged and paid is not as per this section. He should not be of the opinion that you are not follow the rules properly, you are not follow the subsection 1 properly, you are not selected the most appropriate method properly. He should not feel that. He should not be of that opinion. Second, you should always maintain proper documents and information as per 92D. If you don't maintain proper documents and information after 92D, then the AO will determine your arm's length price. Third, for determining arm's length price, you should use the data which is very reliable and correct. You should not use non-reliable or incorrect data. I always say that. You should not take the data from Google or ChatGPT, etc. You should take data from registered entities. I have told you some registered entity in class like Provise, like Capitaline, etc. These are registered entities from whom you can take transfer pricing data. You can purchase the data. Those are authentic data. And fourth, if the AO or CIT appeal ask for the information in 92D subsection 3 and you do not reply to them within 10 days and along with extension within 40 days, 10 plus 30, then also the AO has the power to determine your arm's length price. If any of the 4 things has happened, AO will issue you a show cause notice. He will give you an opportunity of being heard and he will determine your arm's length price. Now let's take an example to understand the 4th subsection. Suppose the total income of the assessee. Suppose the total income of the assessee is 300 lakhs. The transaction price is 100 lakhs. And you have deducted TDS of 10%. This is royalty, for example. So you have deducted TDS 90 lakh rupees and you have paid 90 lakh rupees to other person. The other person has shown 100 lakh as his income. Now pay attention, please. Very important factor. Now the AO says that no, it is not 100. It is transfer pricing. The expense is not 100, it is only 40. So I have to increase my total income to say 360 lakhs. Because earlier I have claimed 100 lakhs as deduction. Now I have to claim only 40 lakh as deduction because the AO is saying that only 40 lakh is correct price. Therefore I have to add back 60 lakhs. Therefore my income will increase by 60 lakhs. My income will become 360 lakhs. Now, consequences. What I cannot do. Whatever income is increased by A over here because of the change in arm's length price. On that income I cannot claim 10 AA. I cannot claim chapter 6A profit link deduction. On this increased income, I cannot claim 10 AA deduction. On this increased income, I cannot claim profit link deduction. These 2 things are not possible. Secondly, today I am paying how much? 100 lakhs I am paying to my associate enterprise. 10% I have deducted. He is showing 90 lakhs as income, net income, gross income 100 lakhs. Now that other person cannot say that my income is also 40. My income is also 40, so they reduce this, cancel this 40, and my income should also be taken as 40, and already 10 lakh has been deducted as TDS, so give me refund. Refund will not be. Other person income will not be recomputed and refund will not be granted to him. So, whatever income has been increased by AO in 92C, on that much income, you cannot claim deduction under chapter 6A and 10 AA, and the other person also cannot claim refund of that much amount. The other person has to show the income as 100 lakhs only. I hope it is clear to all of you. This is a very important point. These 2 points are given under proviso to 92C subsection 4, first proviso and second proviso. You may not remember the proviso, it's okay, but I'm just telling you. Now we will talk about the methods, the 5 methods. In all there are 6 methods, but the 6th method is case to case. So generally there are only 5 methods relevant for us in exam. The first method is the comparable uncontrolled price method. In this, it is very simple. See, certain terminologies you need to understand first, and you have to remember these methods properly, and it is very difficult to explain these methods in words. You need to take some examples, which I have done in the class also. For every method, I have given you some examples, and with the help of examples, I have explained you. Today, the objective is only to revise the things. We will do a lot of questions also when we will do the compilation of 26 papers. Now, pay attention, please, all of you. Pay absolute attention. Suppose what I am doing is comparable uncontrolled price method. Try to understand certain terminology. If I am doing a transaction with my associated enterprise, that will be called as international transaction. And the transaction with which I am comparing, that is the third party transaction, that will be called as uncontrolled transaction. So the transaction with associate enterprise will be called as international transaction, and the transaction with third party will be called as uncontrolled transaction. Now, step number 1 in comparable uncontrolled price. You need to find out the price charged or paid with respect to uncontrolled transaction. That is, find out the third party price. So third party you are selling for 3,000, to your associate enterprise you are selling for 2,000. So take 3,000 as base price, and then find out the functional difference between both of them. And whatever is the functional difference, that you have to add and less. In what? In the third party price. In the third party price you have to add and less the functional differences. Then you will get your arm's length price. Very simple method, nothing great as such. Next method is very important. Resale price method, very dangerous method. In this, again, in every transaction, in every question, there will be two transactions. In resale price method, there will be two transactions. First, where you will purchase the goods from associate enterprise and then you will resell to third party. Transaction number 1, purchase from associate enterprise, resell to third party. Transaction number 2, purchase from unrelated, sell to unrelated. First one, purchase from associate entity, sell to unrelated. Second one, purchase also from unrelated, sale also to unrelated. So what is step number 1? Step number 1 is when you purchase, transaction number 1 is step number 1. When you purchase from associate enterprise and sell to third party, at what price you resell, that is your step number 1. Purchase from associate and sold to unrelated party, at what price you have resold, take the step number 1 as that resale price. Then find out the GP margin of second transaction. When you purchase from unrelated, sell to unrelated, what is the GP margin? That much GP margin you have to reduce from your price number 1. Then you will get your cost. Okay. So while taking the price, you will take the price of the first transaction resale price. While taking the GP, you will take the GP of the second transaction. Now after that you have got the cost. Now when you purchase in the first transaction, after purchasing you might have incurred some purchase related expenses. After purchasing you might have incurred some freight, you might have incurred some customs, that also you have to reduce from your cost. And then you have to compare both the transactions, what are the functional differences, discount is there, warranty is there, etc. Accordingly you adjust, and then you will get your arm's length price. First and the second step is very important. Third method, profit split method. Profit split method is used when you do generally a joint venture with multiple entities. Suppose there are 3 entities which are doing some project and they are earning some profit. Now how the profit will be split between them? So first of all, find out the combined profit of all of them. Suppose the combined profit is $10,000. Now you have to divide this combined profit into relative contribution ratio. Sir, what is relative contribution ratio? That will be given in the exam, don't worry. That will be identified based on FAR analysis, function, asset and risk analysis. That will be identified based on who has put how much efforts in this particular transaction. So suppose the relative contribution ratio is 50%, 30%, 20%. So step number 1, find out the combined profit, $10,000. Then step number 2, find out the relative contribution ratio. Now divide the profit into this ratio. 50, 30, 20. So 10,000 divided into 50, 30, 20 is equal to 5,000, 3,000, 2,000. Now give 5,000, 3,000, 2,000 to everybody, and they will add this 5,000, 3,000, 2,000 to their cost. Profit will be added to their respective cost, and you will get your arm's length price. As simple as that. This method is not very important method for examination. Okay. Now coming to cost plus method. This method and the next method is the most important method for the examination. Be very careful. One of the most important methods which are very commonly asked is cost plus and transactional net margin. Now there is a great difference between these two methods and the previous 3 methods. In the previous 3 methods, we were making adjustment in the price. You can go and check. In first method, you are making adjustment in price. Second method also you are making adjustment in price. Third method also you are making adjustment in price. In fourth and the fifth method, you are not making adjustment in price. You are making adjustment in margins. In the fourth and the fifth method, you will make adjustments where in the margins you are going to make adjustment. How, sir? Let's see. Cost plus method. I am in India. I am selling some goods to my associate enterprise on cost plus some margin. I'm also selling some goods to third party. So I need to find out the arm's length price of the transaction which I'm doing with my associate enterprise. So step number 1, find out the direct and indirect cost with respect to associate enterprise. So whatever is the direct and indirect cost with respect to associate enterprise, find out that first. Okay. After that, when I'm selling to the third party, what is the GP markup in that case? So the cost you will take of whom? Step number 1, the cost you will take of your associate enterprise, and the markup you will take of the third party. And then you will adjust in the markup. You will adjust in the markup, at less, you will find out a revised markup. And that markup you will add to your cost, and then you will get your arm's length price. So again, I am saying the cost you will take of your associate enterprise, the markup you will take of third party, and that markup you will adjust, find out the functional difference between both of them. And then after doing the functional differences, then whatever the revised markup will come, that you will add to your cost. That will give you your final arm's length price. Transactional net margin method. What is transactional net margin method, sir? In practical life, maximum people use this method only as their transfer pricing method. Here also there are two parties. One transaction I'm doing with my associate enterprise, another transaction I'm doing with my third party. So you need to find out the margin of your transaction and margin of third party transaction. The margin can be net profit upon sale, net profit upon cost. But sir, when to take sale in the denominator, when to take cost in the denominator? The law is saying take the relevant base. Take the relevant base. Relevant base means what? I have told you in the class. If you are exporting, if you are selling, take the relevant base as cost in the denominator. And if you are importing, if you are purchasing, then take the relevant base as sales in the denominator. I have mentioned in the note below. This entire line is not there in the study material. So students are confused when to take cost, when to take sales. It's very simple. If you are exporting, take cost. If you are importing, take sales. Sir, logic I have told you in the class that you have to take the denominator as an untainted denominator. So if you are selling, the sales will be tainted. Therefore, take cost as untainted. If you are importing, then the purchase cost will be tainted. Therefore, take the sales as denominator. So step number 1, find out the margin with respect to associate enterprise. Then step number 2, find out the margin with respect to uncontrolled transaction. Then adjust the margin. Here also margin will be adjusted. See if there is any functional differences, both of them. Then adjust the margin. After the margin is adjusted, use that margin to find out the arm's length price. I hope it is clear to all of you. So this is what this 5 methods are all about. Along with this, there is one 6th method also, which the CBDT may prescribe on case-to-case basis if you are not able to identify your arm's length price properly. But that is not relevant for our exam. Now, coming to the very dangerous paragraph. Very dangerous provision. It is very difficult to explain this now in words. I have given you all these things in class in great detail. There are multiple questions on this issue in your textbook also, in your question bank also. In all our batches of regular batch, exam-oriented, practical question batch, in every batch, I have discussed this provision in great detail. What is this provision? Now see, whenever I have to compute my arm's length price, I have to compare with someone. Okay. So when I compare with someone in the market, there are multiple prices that I can get in the market. Obviously, if I am selling this pen, there are many other people who are selling this pen in the market. So which price I should take? There will be always more than one arm's length price. There are hundreds of people who are selling this pen in the market. There are hundreds of people who are selling this pen in the market. So whose price I will take? So it is bound to happen that there will be multiple arm's length price in respect of one transaction. So if there is more than one arm's length price, then you have to follow rule 10 CA. Rule 10 CA will tell you the mechanism in which how you are supposed to compute the arm's length price, and that mechanism is called as range concept. First of all, range concept is applicable to whom and not applicable to whom. Let me tell you that. Out of the 6 methods, the range concept is applicable only to 4 methods. It is applicable to cup method, it is applicable to resale price method, it is applicable to TNMM, and it is applicable to cost plus method. Range concept is not applicable to profit split method and the 6th method. It is not applicable. It is only applicable to 4 methods. Plus, the number of entries that you get in the market should be at least 6 or more, then only range concept is applicable. Otherwise, range concept is not applicable. These 2 things you have to keep it in mind before going ahead with the concept of range concept. So to apply range concept, your method should be either of the 4 methods I have told you. And in that also, to apply range concept, you need to have at least six entries from the industry. 6 entries where similar transaction is done by people with their unrelated party. At least 6 company data should be there. 7 is okay, 10 is okay, 15 is okay, but at least 6 has to be there. So cup method, resale price method, cost plus method, and transaction net margin method. In this also, for cup method, you have to take only current year data from the market. But for rest of the 3 methods, you have to take current year data and last 2 years data and average it. For cup method, you have to take only current year data, and for rest of the 3 methods, you have to take current year and last 2 years average. So let's talk about TNMM. In case of TNMM, what should I? Sir, is TNMM, is range concept applicable for TNMM? Yes, range concept is applicable for TNMM. Range concept is only not applicable for profit split method and sixth method. Range concept is applicable to TNMM. So in TNMM, sir, what is the margin that we take? OP upon OC, operating profit upon operating cost, or operating profit upon operating sales. So suppose we are selling, we are exporting, so we will take OP upon OC. So what should we do, sir? Go to the industry and find out at least 6 companies who are doing similar transaction and who is doing transaction with unrelated party, and find out their OP and upon OC for current year and last 2 years. So I have got the data of 7 companies, sir. OP upon OC of 7 companies. Great. If you have got the data of OP upon OC of 7 companies, that's great. Find out OP, find out OC of 7 companies of current year and last 2 years. And then do what? Add OP of last 3 years, current year and last 2 years. Add OC of current year and last 3 years and find out a percentage. Find out margin. I want at least 6 margin. 7 is also okay. 8 is also okay. 10 is great. 20 is great. At least 6 I want. Sir, I have 7 companies data. Great. Find out 7 margins of unrelated party. And then lay down those margins in ascending order. First of all, find out the margin individually and then lay down in ascending order. And then take 35% of 7. 35% of 7. If that is coming to fraction, all these things are mentioned over here. I am not saying this all from my side. Please take what? Check here. 35%. Where it is written? If it is a fraction, then take the data of the next number. So 35% of 7 is obviously fraction. So take the data of next number. So 35% of 30 is coming to some 2.45 something. So take 3. Then take 65% of 7. 65% of 7 is coming to something 4 point something. Then go to the next number. Take 5. Then 3 to 5% is your range. 3 to 5. On 3, check how much percentage there, and on 5, how much percentage is there. That is your range. If you are within that range, great. Nobody will ask you anything. But if you are outside that range, then you have to find out median. Median means 50% of 7. Again, 50% of 7 is 3.5. It is a fraction. Go to the next number. Next number is 4. Add 4. You have laid down 7 items. Add 4. Whatever is the percentage, that will be your arm's length price. Sir, what if these numbers are not fraction, but if these numbers are whole number? If these numbers are whole number, then you have to make slight changes. Suppose number of items you have collected from the industry is 20. So what is 35% of 20? It is 7. Now this is a whole number. Now don't take next number directly 8. Now take average of 7 and 8. That will be your first number. Again, 65% of 20 is how much? 65% of 20 is 13. Again, it's a whole number. Now take average of 13 and 14. So whatever is the range, that will become your arm's length price. If you are within this range, the department will accept. If you are outside this range, the department will tell you to compute the median, and that will become your arm's length price. This is what this provision is all about. Sir, what if the number of items in the industry is less than 6? Then range concept is not applicable. Then what should we do? You should do only one thing, then take arithmetic mean of all the prices. If you have only 5 prices or 4 prices or 3 prices in the industry, then take the arithmetical mean of the 3 prices, 4 prices, 5 prices. To apply range concept, you need to have at least 6 companies data. So if it is less than 6, take arithmetic mean and then compare with your actual price. If the difference is up to 3%, ignore. If the difference is more than 3%, then this price will be applicable. Suppose the arithmetic mean is coming to 103 and your actual price is 102, then ignore 103. Take 102 actual price. But if the arithmetic mean is coming to 103 and your actual price is 95, now the pricing difference is more than 3%, now you take 103 as arm's length price. I hope it is clear to all of you. This is what the range concept is all about, and Rule 10CA is applicable. Rule 10CA is applicable when, again I am saying, it is applicable when there is more than one arm's length price. So you have to follow the range concept for 4 methods. Okay. Now, there are some issues over here. One is the Supreme Court judgment and second one is the bright line test concept, which I will be saying now. So what does the Supreme Court judgment say now? See, generally we know that we have done in the chapter of appeal in our classes that ITAT is the last fact-finding authority. If you want to go beyond ITAT, there has to be question of law. So now the question is whether the High Court has the power to determine the arm's length price. Whether the High Court has the power to determine the arm's length price, because determination of arm's length price is a question of fact. It's not a question of law. So here the Supreme Court has given a very beautiful judgment. The Supreme Court has said that no, High Court does not have the power to determine the arm's length price, but yes, High Court definitely has the power to interfere and say that whether the arm's length price has been determined as per the income tax law and its rules or not. Whether the interpretation of law has been done properly or not, that High Court can definitely say. Because ultimately arm's length price is determined as per 92C and its rules, and it's a law. So High Court has the power to interpret the law and say and interfere between the assessee and the department and say that yes, the arm's length price is not properly computed as per the Income Tax Act and its rules. That power High Court has, and nobody can stop the High Court from doing this. Therefore, by default, High Court cannot determine the facts of every arm's length price, but High Court can definitely say that the arm's length price is computed as per the rules, as per the law, or not as per the rules, not as per the law. That power High Court definitely has. I hope it is clear to all of you. Next is a very global concept not applicable in India, bright line test. We need to understand first of all what is this bright line test with an example. Suppose there is a company by the name called as Sony, which is in Japan. Now Sony has opened a subsidiary in India, and Sony has told its subsidiary in India to do massive promotion in India in the form of advertising, marketing and promotion expenses, AMP expenses. So Sony is in outside India, Sony parent is in Japan, and Sony India is in India. And Sony India is doing what? Massive advertising, marketing and promotion expense. So there is a concept of bright line test in many countries outside India, where the subsidiary in the home country is doing some promotional expenses. Then all the promotional expenses should be categorized into two parts, routine and non-routine. Routine expenses will be allowed as deduction. Extra non-routine expenses will not be allowed as deduction as per bright line test. Now this bright line test concept is not there in India. Still the assessing officer is applying this bright line test on Sony India and even on Bosch and Lomb India, etc. and many other companies. So the Delhi High Court has held that you cannot apply the concept of bright line test in India in the absence of machinery provision. There is no computation mechanism in India to divide what is routine and what is non-routine. There is no concept of bright line test in India to divide between this much is routine, this much is non-routine. The advertisement, marketing and promotion expenses incurred by the Indian subsidiary is not an international transaction. Therefore, transfer pricing cannot be applied on that transaction. The advertising, marketing and promotion expenses is done with third party, not with associate enterprise. Therefore, transfer pricing cannot be applied in this case. I hope it is clear to all of you. Is it clear? Now, let's talk about the next provision, reference to TPO. Very important section. Some important amendments have also been made in this particular section. Reference to TPO. In this, there are three parties. Try to understand the three parties first. I am an assessing officer. You are an assessee. And there is a transfer pricing officer sitting over here. Sir, who is a transfer pricing officer? A transfer pricing officer is nothing but an assistant commissioner, deputy commissioner or joint commissioner of income tax who has been empowered to do this job, who has been empowered to do the transfer pricing matters. So I am an AO, you are an assessee, and there is a TPO. I am doing your assessment and I am computing your international transaction arm's length price and domestic transaction arm's length price, and I am having some issues in computing the arm's length price. So I have the power to refer your arm's length price to TPO. Before referring, I will take a previous approval of commissioner and I will refer the arm's length price to TPO. I can refer international transfer pricing also. I can refer specified domestic transaction also to the TPO. Then TPO, before doing that, before referring the transfer price, referring the computation of arm's length price to the TPO, I will take commissioner approval. After that, the TPO will send you a notice and will ask for the information. Will ask you to produce information. TPO himself will also gather some information. Now, some very important issue. Suppose I have referred TPO that, sir, I am not able to understand the arm's length price of this royalty. Please try to find out the arm's length price of this royalty. So the TPO will identify the arm's length price of this royalty. Now the question is, if TPO suo motu wants to find out the arm's length price of some other transaction also, like FTS, like purchase, sale, can he do so? The answer is yes. The TPO has been given the power to find out the arm's length price of other transaction also which are not referred to him. So he can find out the arm's length price of the transaction which is referred by AO and also which is not referred by AO. I hope it is clear to all of you. So after that, the TPO will do that. TPO will gather all the evidence from the assessee. TPO will also gather all the evidence from his own end, and then he will pass an order in writing. The order of TPO will be given to the AO and to the assessee, and the order of the TPO will be binding on the AO. Whatever the TPO will be saying, AO has to follow that. By when the TPO will pass the order, sir? He will pass the order at least 60 days before the completion of assessment due date. What is the completion of assessment due date? I'll tell you very clearly. For previous year 25-26, assessment year 26-27, the by default time limit to complete regular assessment, best judgment assessment is 12 months from the end of relevant AY. So 12 months from the end of relevant AY from AY 26-27 will be 31st March 28. Now, because you have referred the matter to TPO, you will get extra 12 months. Because if the matter is referred to TPO, the assessing officer gets extra 12 months. Therefore, 31st March 28 will become 31st March 29. So 31st March 29 will become the last day to complete assessment. At least 60 days prior to that, TPO should pass an order. At least 60 days prior to that means the TPO should pass an order by 30th of Jan 2029. So if the TPO passes the order till 30th Jan 2029, you can say that the TPO has passed an order at least 60 days prior to that. I hope it is clear to all of you. Now, in that also, in this entire process, if the proceeding is held by any court, if the proceeding is put on stay by any court because of which the time is lost, suppose the court has put your proceeding on stay for 40 days, or if the assessing officer is asking information from foreign authority, therefore the assessments are stopped now in between for 40 days. So therefore, the TPO and the AO will get extra 40 days time, and after that also, whenever the proceedings will be resumed, after that they should get at least 60 days time to complete the proceedings. So first of all, if the proceedings are kept on hold because of court stay or because of the information they are going to get from foreign authorities, say it is kept on hold for 30 to 40 days, say 30 days. So whenever it will be resumed, you will get extra 30 days, and after that, whenever it will be resumed, you will get extra 60 days. Even after excluding this 30 days, at least 60 days more should be there to complete the proceeding in your case. Now, TPO is ultimately a human being. While passing the order, the TPO can make a mistake. Yes, if the TPO makes an apparent mistake, the TPO will rectify the order under 154. The TPO will rectify its order under 154. Now, because the TPO has made a mistake, therefore the assessing officer would have also made a mistake. Why? Because TPO's order is binding on the assessing officer. So if TPO has made a mistake, AO has also made a mistake. So if TPO rectifies, even AO has to rectify the order under 143, 144, 147. Even AO has to rectify their assessment orders. Then TPO has been given some extreme power to issue summon, to call for information, to conduct survey also. And last but not least, this proceeding will also become faceless now. I hope it is clear to all of you. This proceeding will also become now faceless. No need to physically present in front of the TPO. Now, one very important amendment has been made in Finance Act 2025. What is that amendment? Suppose previous year 25-26 is going on, 26-27 AY is going on, previous year 25-26 assessment is going on, and in this assessment the TPO has determined the arm's length price of your royalty as 100 crore rupees. Listen carefully. So for previous year 25-26, if the TPO has determined the arm's length price of your royalty as 100 crore rupees, so now the TPO has passed the order. Now you feel that it is correct, so you can tell the assessing officer next year onwards that please for next 2 years also apply this particular TPO's order. Don't refer for the next 2 years. For the next 2 years also apply this same price for royalty. I am happy with this price. So that will reduce the litigation. That will unnecessarily reduce reference to TPO again and again in multiple years. In 1 year, if the AO has referred and AO and the TPO has found the arm's length price for a particular transaction, say royalty, and in second year and third year also, if the assessee accept that, it will reduce the time, it will reduce the wastage of time for everybody, for me also, for assessee also, for AO also, for TPO also. So let's see now. The ALP determined for an international transaction as per 92 CA for any previous year shall be similar, but this provision is not applicable for block assessment. For block assessment people, this provision is not applicable. This is applicable for regular income escaping best judgment assessment, not for block assessment. So again I am reading. The ALP determined for international transaction or SDT as per 92 CA for any PY, say previous year 25-26, shall apply to similar transaction, say royalty, for 2 consecutive PYs immediately following such PY. Our PY is 25-26, so 26-27, 27-28 also you can apply. A new subsection has been inserted to provide that ALP being determined in relation to international transaction under subsection 3 for a PY shall apply to similar international transaction STD for 2 consecutive PYs immediately following such PY and fulfillment of certain conditions specified therein. Okay, now this is repeating only. Now, how to opt for this? You have to file an option. You have to file a form. The SSC shall be required to exercise an option in prescribed form, manner and time period. So what is that form number? I don't know. By when I should fill that form, that I don't know. Time limit will be prescribed by the law. I don't know what is the time limit. This option cannot be exercised in case of block assessment. In case of search cases, this option is not valid. Now, after you give an application to the TPO will pass an order within 1 month from the end of the month in which the option is exercised and declare the option as valid subject to prescribed condition. So once you make an application, TPO will declare the option as valid, and for the next 2 years also same arm's length price will be applied in your case. No need to refer again and again. And once the TPO declares the option exercised as valid in respect to an international transaction or SDT for any previous year, for 2 consecutive previous year immediately following such previous year, for such 2 previous year, now the AO will not refer for TPO. So for the next 26, 27 and 27, 28, AO will not refer to TPO. And if he has already referred, and then I made an application, he has referred first and then I made an application, then he will cancel the reference. He will cancel the reference. He will stop that particular proceeding and he will accept my what? He will accept my price for the next 2 years. Then TPO's order will be given to AO, and then AO will pass the final assessment order, etc., all these things. And that will be done within 3 months, nothing great as such. So the rule is very simple. Whatever the TPO has said for the current year, you have an option. Department does not have an option. Assessee has an option to tell the department, please apply for the next 2 years. For that, you have to fill a form. Once you fill the form, the TPO will pass an order within 1 month, declare your application as valid for the next 2 years. And then for the next 2 years, no fresh reference will be made by the AO to TPO. I hope it is clear to all of you. So we will take a break for 2-3 minutes and then we'll continue. Okay. So let's go ahead with the next part now. Then the next part is a very important part for examination, which is very recently inserted. It was not applicable for the last 8 years. After 8 years, the institute has introduced this particular concept in your exams. And that is safe harbor rule under 92 CB. What is safe harbor rule? Now, safe harbor rule is applicable in two cases. One, it is applicable in case of transfer pricing cases, and another it is applicable in case of determination of income under section 911. That is in case of business connection. So first we will talk about the safe harbor rule in case of transfer pricing, and then we will talk about the safe harbor rule in case of business connection. So what is safe harbor actually? Safe harbor is nothing but the government is giving the associate an option in case of certain businesses. If you fall in case of that business, then you should show some margin which the government will tell, and if you show that one margin, we will not question your price, but you have to show that much margin to the department. For that, you have to fill a form, form 3 CEFA, etc. That CEFA form can be filled for 1 year, 3 years. That procedure we will say in a while. Secondly, even if you fill this form and opt for this safe harbor rule, you have to maintain two things. You need to maintain documents under 92D, and you have to fill form 3CB, that is 92E has to be fulfilled. You will not be relieved from documentations and filing of form 3CEB, that is the report, audit report. That you have to do. Yes, your transfer pricing arm's length price will not be questioned. So first of all, we need to find out who are those fortunate people for whom this benefit is available. Let's see one by one. The very first fortunate people is, what all things we are supposed to remember, sir? You are supposed to remember the nature of business. You are supposed to remember the transaction value. You are supposed to remember the margin. These are the three minimum things you have to remember. After that, whatever you want to remember, you remember. The very first thing, provision for software development services. First of all, what is software development services? It is defined under the income tax law. What all things are there under the software development services, sir? Sir, are we supposed to remember that? I am not saying you have to remember, but at least you need to know, have an idea about what all items are coming inside that. Like software development service includes business application or information system development using known methods or existing tools. Support for existing system, computer language conversion or translation. They may put, instead of directly putting the word software development service, sometime they will play with you and they will put the SSC is engaged in computer language conversion. So that it indirectly means the SSC is engaged in software development service. The SSC is engaged in computer language services. Is the safe harbor rule applicable? You have to say yes. Safe harbor rule is applicable subject to other conditions. Adding user functionality, system debugging. I have explained you the meaning of all these things in the class if you remember. Existing software adaptation, user documentation preparation, but does not include research and development services, whether or not in the nature of contract research and development services. These two lines are separately covered in separate business. So yes, you cannot completely ignore them. Read them as many times as possible. Don't by heart them, but you have to read them. You need to have in your conscious mind. There should be a screenshot in your mind that yes, this item is there and it is covered under what? Under the definition of software development services. Once you know that it is software development services, now your operating profit margin in relation to operating expense. This is nothing but OP upon OC. This should be at least 17% if the value of international transaction is up to 100 crore. And it has to be 18% if it is more than 100 crore and up to 300 crore. So if the transaction value is up to 100 crore, then 17% should be margin. If it is more than 300 crore but up to 300 crore, then 18% margin you have to show minimum. If you show more than this, then great. If you show less than this, safe harbor rule not applicable. Sir, what if the transaction value is more than 300 crore? Then also safe harbor rule is not applicable. In this case, maximum transaction value should be up to 300 crore. If the transaction value is more than 300 crore, safe harbor rule is not applicable. I hope it is clear to all of you. Second one, provision of IT-enabled services. Sir, what do you mean by IT-enabled services, sir? Let's see. What do you mean by IT-enabled services? That is also defined. IT-enabled service is nothing but BPO service, call center service, service center service, etc. BPO services using IT, including back office. You are providing some back office services to some big company. Call center, contact center, data processing, mining, insurance claim processing, small things, not big. Legal database, medical transcription, excluding medical advice, translation, payroll, remote maintenance, revenue accounting, support center, website service, data research, integration, analysis, remote education, excluding content development, clinical development based, database management, excluding trials, but again does not include contract research and development services. Here also margin is same only, 17% up to 100 crore and 18% above 100 crore up to 300 crore. But I think so mistakenly ICI government has written over here aggregate. If you see all other cases, the word aggregate is not written. Only in this case, aggregate word is written. Rest all it is written the value of international transaction. Nobody pays so much attention. Don't worry. You assume this to be also as value of international transaction only. Just assume same only. Don't get into the aggregate of concept. But technically, the word used over here is aggregate. If you see the original law, if you see actually rule of the safe harbor rule on the CBDT website. Here also the margin should be same only. 17% up to 300 crore and above 100 crore. Up to 300 crore, 18%, above 300 crore, safe harbor rule not applicable. Margin means OP upon OC. Sir, what is OP upon OC, sir? For that, you need to find out, sir, what is OP upon OC. Operating expense is your denominator, okay? And your numerator is operating profit. So, from the revenue, you have to reduce this. From revenue, if you reduce the expense, you will get your profit. Whatever is your revenue, from that, you reduce your expense, you will get your profit. Sir, what does expense include? Expense will include all costs incurred in relation to international transaction. Point number one, count with me. Second, it will also include the ESOP provided to our employees by associate enterprise. If associate enterprise is providing ESOPs to our employees, then that ESOP cost is also included in this. Third, reimbursement to AE. If AE has incurred some expense on our behalf and we have given them some reimbursement. Fourth, if they have incurred some expense on, we have incurred some expense on their behalf, so amount recovered from AE. So all these things are covered. Again, check. First, cost which you have incurred with respect to the international transaction. Second, if AE has provided some ESOP to your employees, then the cost with respect to that ESOP also. Third, reimbursement you are doing to AE. AE has incurred some expenses for you, you are reimbursing them. And vice versa. You have incurred some expense for AE and they are reimbursing you. You have to take these four things in your cost. And you also have to take depreciation, amortization relating to the asset used by the assessee. But do not include these things. Do not take financial expenses like interest, unascertained liability, pre-operative expenses like preliminary expense. Do not take forex fluctuation losses. Do not take extraordinary expenses, loss on transfer of assets. Income tax expenses do not take. Further, the reimbursement that we are getting and the reimbursement that we are doing, both of them should be done at cost. We should not add margin in that. The reimbursement that we are doing, that should also be done at cost. Whatever they have paid, we should pay them. If they have paid and they have paid 100, we are paying them 120. Take only 100. If we have paid 120, they are paying us 150. They take only 120. Don't take extra. Take only at cost. Sir, are we supposed to remember this? Don't remember all these things. But yes, nature of business you have to remember. You may forget this, it's okay. But nature of business you try to remember, okay? Don't try to remember what is operating profit, what is operating cost. That they will directly give in the exam, don't worry. Provision of knowledge process outsourcing services. Sir, what is knowledge process outsourcing services? Let's see the nature of business first. It is IT-based services with advanced analytical or technical skills, including geographic information system, human resources, engineering or design, animation, content development management, business or financial analytics, market research. Again, does not include any research and development, whether or not in the nature of contract research and development services. It does not include that. I hope it is clear to all of you. Is it clear? Now, coming to what? How much margin I am supposed to show. First of all, for KPO services, the transaction value should be up to 300 crore. Only one margin, one slab is there. 100, 300, multiple slabs are not there. Only one slab. The transaction value should be up to 300 crore. Okay. Second, the margin should be 24% if the employee cost divided by total expense is less than equal to 60%. So if the employee cost divided by total expenses up to 60%, the margin should be minimum 24%, not less than that. If the employee cost is 40%, but less than 60%, then the margin should be less than, it should be 21%. And if the employee cost is less than 40% or equal to 40%, then the employee cost should be 18%. I've told you in the class also that there is some mistake over here. This and this, if you read carefully, this is overlapping. This is not a mistake by me. This is a mistake by CBDT only, which I've told you in the class. Okay, if you remember. So here also 40% is coming exact. Here also exact 40% is coming. Try to remember that. Now, next one, very important. Advancing of intra-group loan in Indian currency, and the next one after that, advancing of intra-group loan in foreign currency. Let's talk about Indian currency first. But before that, let's try to understand what do you mean by intra-group loans. This is a very important definition for us. Intra-group loan means loan given to non-residents, associate enterprise. Loan which is given to only non-resident associate enterprise, not from any financial company or bank or enterprise or lending or borrowing enterprise. Plus, it does not include credit line or loans without fixed repayment. There has to be loan with fixed repayment, and there has to be no credit line. Okay, it does not include credit line. Credit line means it's kind of bank overdraft. We are giving you a credit, you can withdraw whenever you want. You don't want to withdraw, don't withdraw. It should not be of that. It should be an absolute loan. So it should be a loan given to non-resident. It should be a loan given to associate enterprise. It should not be from financial company or banks or money lending business people. It should not be a credit line. It should not be a loan without fixed repayment. If it is all these conditions are fulfilled, it is an intra-group loan. Now here, the margin is nothing but the interest rate. The interest rate will depend upon your credit rating. The credit rating of the borrower will decide the interest rate. The interest rate will be SBI's 1-year MCLR plus SBI's 1-year marginal cost of lending rate on 1st April 2025 plus 1.75% if the credit rating of the borrower is AAA to A, plus 3.25% if the credit rating is BBB minus, BBB plus, plus 4.75% if the credit rating of the borrower is 4.75 is BB to B, plus 6.25% if the credit rating of the borrower is C to D. And if there is no credit rating, then there is a limit on the loan amount. If there is no credit rating, then the loan amount, aggregate loan amount till 31st March of the relevant previous year, 31st March 2026 should be up to 100 crores. So if there is no credit rating, then the aggregate loan amount should be up to 100 crore, and then it is MCLR plus 4.25%. In the first 4 cases, there is no limit of loan amount, but if there is no credit rating, then loan amount up to 100 crore is only covered in safe harbor. If it is more than 100 crore, safe harbor is not applicable. What about intra-group loan in foreign currency? In this, there are 2 slabs. If the loan is up to 250 crore, then the slabs are different, then the rates are different. If the loan is above 250 crore, then the rates are different. Here you have to take reference rate on 30th September, not MCLRs. SBI's MCLR is not applicable for foreign currencies. Here you have to take reference rate on 30th September. So if the loan is up to 250 crore, you will take reference rate on 30th September plus to 1.5% if the credit rating is AAA, AA plus, AA minus, A plus, A minus. Reference rate on 30th September if the loan is up to 250 crore plus 3% BBB plus, BBB minus. 4% plus reference rate on 30th September if the loan is up to 250 crore, BB plus, BB minus, B plus, B minus, C plus, C minus, D, or no credit rating. No limit of 100 crore also over here. No limit. 100 crore limit which was there na here in case of no rating. Here there is no limit of 100 crore. Next, if the loan amount is greater than 250 crores, then there are four options now. Here it was three options. Here there are four options. 1.5%, triple A, double A plus, double A minus, A plus, A minus. Reference rate on 30th September plus if the loan amount is more than 250 crore, the triple B plus, triple B minus. 4.5%, double B plus, B minus, B plus, B minus. And 6% plus reference rate on 30th September. C plus C minus D or no rating. Again, no limit of 100 crores. Okay. Next one, corporate guarantee. We are providing corporate guarantee. Sir, what do you mean by corporate guarantee, sir? Let's try to understand what do you mean by corporate guarantee. Corporate guarantee will only include explicit corporate guarantee to the wholly owned non-resident subsidiary. That's it. If it is provided to other than subsidiary, then it is not covered in safe harbor rule. Corporate guarantee, first of all, should be explicit corporate guarantee. And plus, it should be only to non-resident subsidiary, that to wholly owned subsidiary, not small subsidiary. For long-term or short-term borrowing, it does not include letter of comfort. Corporate guarantee will not include letter of comfort, will not include implicit guarantee, will not include performance guarantee or similar guarantees. It should be explicit guarantee to the subsidiary, wholly owned subsidiary, which is the non-resident. I hope it is clear to all of you. They might play with these words. They have played with these words around 8 years back when safe harbor rule was applicable. I used to teach that. I know that what kind of question they used to ask. Only that places I am putting emphasis. Now, providing corporate guarantee where the amount guaranteed does not exceed 100 crores. Or if it exceeds 100 crore, then the credit rating of the borrower of the associate enterprise should be adequate to safety as per, should be adequate to of highest safety as per SEBI guidelines. As per SEBI. So, first of all, the company to whom you are giving corporate guarantee, the guarantee should not be more than 100 crore. If it is more than 100 crore, then there has to be adequate safety of that particular entity as per SEBI guidelines. Margin, just 1% of the guaranteed amount. That much minimum you have to charge. If you charge more than 1%, great. If you charge less than 1%, safe harbor not applicable. Next one, providing contract research and development software services. Now you are providing software services, software development. You are providing contract research and development. Here, your transaction value should be 300 crore and the margin OP upon OC should be at least 24%. Providing contract research and development for generic pharma drugs. What are generic pharma drugs? Generic pharma drugs are nothing but copy of the branded pharma, copy of the branded medicines. Those are generic pharma drugs which are available at cheaper price, similar composition, but lesser quality material are used in that. So you are providing contract research and development for generic pharma drugs. Again, 24% margin should be shown, and if the transaction value is up to 300 crore. So if the transaction value is up to 300 crore, your margin should be at least 24%. Okay. Next, manufacturing of core auto component. Manufacturing and export of core auto component, you have to show margin of 12%. And for non-core auto component, which are not very important in the automobile sector, that will be subject to 8.5% margin. Minimum this much has to be shown. And in these two cases, there is no limitation of amount. There is no limitation of amount. And last but not least, you are receiving low value adding services, intra-group service. Low value adding services means not very great service. Some very small services, which are not significant, which are not important part of the organization. Those services are called as low value adding services. So if you receive the low value adding services, your total value of the international transaction should be 10 crore and the markup in that should not be more than 5%. So the total value of the transaction should be 10 crore and the markup should be maximum 5%. So if the total value is 9.9 crore, the cost is 8 crore and the markup is 1.9 crore. This is not applicable because 8 plus 1.9 crore is more than 5%. So the cost plus markup total should be 10 crore and within that the markup should be only 5%. I hope it is clear to all of you. Further, the cost and the exclusion of the shareholder cost and the doubly cost, all this will be certified by an accountant, and they have also defined the word accountant. I am not getting into the definition of that. I have explained you that in class if you remember. Now, last but not least, I have told you that if you want to follow transfer pricing safe harbor rule, then you have to maintain documents as per 92D and you have to also fill form 3CB in 92E. You will not get relaxation from these two sections. Even if you are opting for safe harbor, you have to follow this. Now, how to opt for safe harbor? Very simple procedure is there. You have to fill a form 3 CEFA and give it to the AO by the due date. You can give it for a single year and you can also give it for a multiple year. You can give for 1 year or you can give for 3 years also. You have to give the statement to the assessing officer before the due date of filing of return. After that, The assessing officer may accept the application or he may not accept your application. He may feel that you are doing eligible. He will check whether you are doing eligible transaction or not, you are showing proper margin or not. If he has any doubt, he can refer the matter to TPO. Okay. He can refer the matter to TPO, and then the TPO may request you to furnish some documents. After that, the TPO may declare your application to be invalid. The TPO will say that you are not eligible for safe harbor. He will give you an opportunity of being heard. If you are not happy with TPO, then you should go and appeal to commissioner within 15 days. You have a power to object to the commissioner within 50 days. Within 15 days, you can object to the commissioner. Then the matter has been to commissioner. The commissioner will check the validity and will send the copy to AO and assessee. The commissioner will check the compliance. If it is fine, then great. If it does not fine, then you have to find out the transfer pricing as per the normal provisions of the income tax law. I hope it is clear to all of you. So this is what this small procedure is all about. So you fill the form, give form 3 SEPA till the due date for 1 year or multiple years, for 3 years maximum. AO will check. AO may declare valid, invalid. AO may also help the TPO. TPO may check valid, invalid. If TPO declares invalid, then you should go to whom? You should go to commissioner. Commissioner will check valid, invalid. If commissioner check and says valid, great, go for safe harbor. Commissioner say not valid, then you should follow the transfer pricing as per normal provision. I hope it is clear to all of you. Last 1 or 2 points over here. Very important point. Rule 10F. Very important for exam. Be very careful. Safe harbor rule is not applicable in some cases if you do transaction with a person located in NJA. If a person is located in notified jurisdictional area, if you are doing transaction with that person, safe harbor rule is not applicable, or safe harbor rule is not applicable if you are doing a transaction with a person which is located in no tax or low tax jurisdiction. Now, no tax is understood that there is no tax in that country. What do you mean by low tax? Low tax means the maximum tax in the other country is less than 15%. That will be called as low tax jurisdiction. What do you mean by no tax or low tax jurisdiction? Where the maximum tax rate in the other country is less than 15%, that country will be called as low tax jurisdiction. If you are doing transaction with a person located in NJ, or if you are doing transaction with a person where the maximum tax rate is less than 15%, then safe harbor rule is not applicable. So for safe harbor rule to apply, the other country should not be NJA, notified judicial area, and the other country's maximum tax rate should be minimum 15% or more. Then only safe harbor is applicable. Further, once you have gone for safe harbor rule, then your doors of mutual agreement procedure under Article 25 of DTAA will be closed. You cannot approach safe harbor rule as well as mutual agreement procedure under 90 and 90A, both of them. You cannot do both of them at the same time. That is not allowed. I hope it is clear to all of you. So this is what your safe harbor rule of transfer pricing is all about. Now we will talk about safe harbor rule of business connection 911. Now this is applicable to certain businesses. If you remember, we have done in section 911 in non-resident taxation chapter earlier, that if there is a foreign company which is coming to Mumbai, Bharat Diamond Bourse, or going to Gujarat Diamond Bourse, Surat, and they are displaying their uncut and unpolished diamonds, raw diamonds, then that does not amount to business connection. Remember, if they confine their activities to display of uncut and unpolished diamonds, then that does not amount to business connection. Do you remember that? I hope you remember that. So there is a catch over here. If the foreign company is coming to Mumbai, Bharat Diamond Bourse, or Gujarat, Surat Diamond Bourse, and they are confining their activities to only display, then that is not subject to tax. What about they come to special notified zone and sell it? Then it is taxable. Now, if it is taxable, then safe harbor is applicable. So safe harbor is applicable for sale of raw diamonds in special notified zone. So for sale of raw diamonds, safe harbor is applicable. For this only confining to what display, safe harbor is not applicable, because in that case it is not taxable only. So who is the assessee? Foreign company engaged in diamond mining. What is the assessee's business? Selling raw diamonds in special notified zone, Bharat Diamond Bourse, Mumbai and Surat. What is raw diamonds? Raw diamonds are uncut, unpolished, unsorted diamonds, unworked, simply sewn, cleaved or bruted, non-conflict as per Kimberley process. I have explained you all this thing in class. What is Kimberley process or not? Certified by Kimberley Process Authority and classified under Tariff Heading 7102, Custom Tariff Act 1972. You have to make an application. Once you make an application, it is applicable for whom? Foreign company who is doing what? Selling raw diamonds, not displaying raw diamonds. Selling. Where? In special notified zone. Not everywhere in the entire country. So they can show their safe harbor as 4%. 4% of the gross receipt will be considered to be as their safe harbor. If they show more than 4%, we will accept. If they show more than less than 4%, we will not accept. At least 4% you have to show of your gross receipt as your profit. No PGBP deductions will be allowed. WDV of the asset will be computed in the same manner. No UAD will be allowed. No carry forward set off of losses will be allowed. Nothing will be allowed. No business loss, no capital gains loss, nothing will be allowed to set off against your income. Nothing. But documents and Form 3CB you have to fulfill. You have to maintain all the documents as per 92D, and you also have to fill Form 3CB, that is the tax audit report, 1 month prior to the due date of filing of return by 31st of October. Procedure again same. You must submit Form 3 CEFC within the due date of filing of return. Department will accept, they will not accept. If it is invalid, they will reject. Opportunity of being heard will be given, etc. Order will be given that your application is accepted or not. Here also, once you go for this safe harbor and it is accepted, then you cannot go for mutual agreement procedure under section 90 and 90A. Mutual agreement procedure under section 90 and 90A is not possible after this. I hope it is clear to all of you. Now moving on to the next section, 92D. What is 92D? 92D talks about documents and information. Which documents and information? There are 3 subsections over here. Subsection 1 says that if transfer pricing is applicable for you, international transfer pricing or domestic transfer pricing, either of the transfer pricing is applicable for you, you have to maintain a lot of documents and information, and those documents and information you have to maintain for a period of 8 years. But all these documents and information are supposed to be maintained only by those people whose aggregate value of transaction recorded in the books exceeds 1 crore rupees. If the aggregate value of the transaction in the entire year exceeds 1 crore rupees, you have to maintain all these documents and information. See, all these documents and informations are applicable and are supposed to be maintained for what? If your transfer pricing is applicable for you. For applicability of transfer pricing, there is no turnover or limit. Again, understand. If your aggregate transaction value of the entire year exceeds 1 crore, you have to maintain all the documents. But for transfer pricing applicability, there is no limit. Even if 10,000 rupees international transaction is done, transfer pricing is applicable. So for applicability of documentation maintenance, limit is there of 1 crore. For how many years you are supposed to maintain? You are supposed to maintain the documents for a period of 8 years from the end of the relevant EY. The AO or the CIT appeal may ask for the documents and information, then you have to furnish them within 10 days. You can also ask for an extension by making an application. If you give an application and if they extend you, then that is great. If they extend, then it is great. They can extend by another 30 days. Sir, what all documents we are supposed to maintain? Let's check the list of documents that you are supposed to maintain. You need to maintain profile of the multinational groups which the assessee belongs to. Ownership structure has to be known in the documents. Which company holds how much in which company. Brief description of the business and of the assessee and its associate enterprise. Nature and terms of international transaction. Financial estimates by assessee. Nature and terms of uncontrolled transaction. Analysis of comparison between international transaction and uncontrolled transaction. Computation of arm's length price. Actual working. Method. Reason for adopting the most appropriate method. Why you have adopted this method, you have to tell the reason. Official publication. From where you have taken the GP margin. Books of accounts. Price publication if listed. Agreement and the contract of international transaction and uncontrolled transaction. All these documentations you have to maintain. If you don't maintain all this documentation, remember in 92C, the AO has the power to determine the arm's length price. Or if you don't reply, I'm interlinking. If you don't reply to the AO or CIT appeal within 10 days, in that also 92C, the AO has the power to determine the arm's length price. So this is what this provision is all about. So I'm stopping here. From here onwards, we will continue in the next session. I have completely given you the schedule till 31st of March. Almost most of the things will be completed by 31st of March, including your MCQs also, including your, I've given a complete schedule. I will come live on that. I'm committing myself only for that. Otherwise, I will also not follow the commitments. If I commit myself, then I will come on time and I will complete the things on time. And you will get 1 complete month to revise everything. Okay. So till then, take care all of you and just let me know in the comment box, how is your experience of learning direct tax with us? Are you enjoying?